I'm ready. Coffee, and let's go.
Wonderful. Awesome. All right. Well, what we might do is actually start with a little bit of an agenda or what we're going to cover today. And what I might do is almost break down what is tax planning. So walk through like what the idea of it is, and then how us as Inspire actually do that for our clients, and hopefully that sort of helps really understand the process and I guess the value or the benefits, which is pretty cool. I'm going to cover. I'm going to run through or share our goal to save our clients $2.1 million collectively in tax over the next 12 weeks. Like this is the focus for our team at the moment, and it's already cool to see some impressive results so far. And then we'll go through our 12 biggest tax planning strategies. Now, I've got a confession: there are not 12 strategies. There's more than 12. We'll throw a couple of bonus ones in there for everyone. So I hope that's okay. And then the other thing which has been new this year, well, there's been a lot new in 2021, but the interesting thing we've got to make sure we keep an eye on is how does cash flow boost work, and JobKeeper, and also the instant asset write-off, which has been pretty interesting with the COVID stimulus measures. So we're just going to go through. It's pretty simple at the core. So we're just going to go through and share things you might need to consider there, and then Q&A with our accounting team. So we've got plenty of time for Q&A. I might just sort of suggest if you've got a question, the best thing to do is that Q&A box that you'll have on your little Zoom panel. The chat box is okay, but the Q&A is better because we can better manage the answers for you. So how does that sound?
Yeah, awesome. And the Q&A box, guys, it's super important that you do use that because all the other participants can see that as well. And again, we encourage collaboration at all times.
Mm.
Being a business owner can be quite lonely out there. So if you have an important question that you want to ask, it's likely that other people have that same question. So feel free to use that Q&A box, and we'll get to answering some of those questions that you have. Awesome, Ben.
Wonderful. Alrighty. Now I might introduce introduce you to our presenters. We've got me, or my name's Ben Walker. I started Inspire when I was actually 23 years old, and I it's been an interesting journey since that. But I started it because I wasn't really happy with how the accounting industry was trending, and I thought there's a bit of a better way we can do this stuff. And I guess I think we're just over 9 years old now, which seems like a lifetime, but some pretty high low lows as it goes. But the cool thing is the impact that we have with our clients, and I think we've ticked over $13 million in tax savings now. That is an incredible amount of money that we've saved our clients, and 13 million days of impact to families in need through B1G1. And as I mentioned earlier, our goal is to save $2.1 million in the next 12 weeks, just this next 12 weeks. So that's a massive increase on our target to date. So, whew, we got a task ahead of ourselves.
That's it.
And then we've got the lovely Riz joining us. So, Riz, would you like to introduce yourself?
Yeah. Looks like I haven't washed my shirt. I'm still wearing the same shirt in that photo.
uh,
But my wife always says, you need to shop more. Um, but yeah, I am like it says there, I'm the general manager here, and I'm also a chartered accountant. I've been an accountant for over 7 years now. And yeah, just when I started with Inspire, I was looking for a place that I could really make a massive impact, and Inspire and Ben opened the doors to me, and I very quickly saw that what we do here is a super meaningful work, and yeah, I've been really enjoying my time here, helping all the clients that I take care of get the most out of Inspire, and to take them through the journey, well, whether through their wealth journey or their tax journey, just to kind of get to that point of securing financial freedom. So it's been a bit of a interesting year for me. 2020 was a big one. We, me and the team, it's not just me alone, I have a whole team that works with me, has helped save our clients over $3 million in tax through some of the proactive strategies that you're going to see today. So if you're thinking, wow, how do we get there? This is the right place to be, because you're going to find this. It's not really a secret, but the secrets behind how to save some tax. And also because of that, and one of the reasons why I joined Inspire as well is not only we can make an impact to our clients, we can make an impact to the broader audience and community that we work within as well, which is to give, well, there's a dollar sign there, which I think is a bit of a typo, but I hope we
Yeah.
give $3 million one day, but it's 3 million days of impact. So things like help with sanitation, supply to water, education to families in need. And that's through our partner at B1G1, which some of you might have heard of. But essentially, it's this concept that we not only want to impact our clients, we want to help the world out along the way as well. So yeah, really been an exciting few years here at Inspire. And yeah, I look forward to sharing more with you today.
Wonderful. Thank you, Riz. So what I mentioned earlier when I went through what we're going to run through is actually the whole idea of what tax planning is. And you know, I guess to put it simply, it's a proactive process that you go through to implement legal strategies to reduce your tax bill. That's kind of how simple it is. And while I go into a bit more detail on that, I do want to launch a little bit of a poll that's just showing up on your screen now. Now, 2020 has been a bit of a weird one. 2020, 2021, this financial year. The interesting thing is some businesses have not done too well. And there's certain industries, maybe like tourism or hospitality, where you've had so many challenges, not just the call it the initial lockdown, but there's also those extra burdens and things that are thrown on you. Then there's businesses who are kind of chugging along at the same rate, and then there's businesses that have just blown up in the last 12 months in an amazing way. And so I'm actually interested to hear, you know, based on who's joining us today, what's where do you kind of see yourself in terms of your tax bill, your gut feel as a business owner? Like, yes, you might not have known your actual estimate to the T that if you're a client that we might give you throughout this process, but your gut feel on how your tax bill might be looking. So I'll leave that open for another sort of 30 seconds or so. G'day, Chris. Didn't see you there, mate. Good to have you here. From our perspective, I've kind of got 5 dot points of what our tax planning sort of involves. It's between March and June every single year, and it's also every single client. Now, the reason why we enforce that is because it's so critical. It's just such a no-brainer part of working with a client that we need to do this with you. There's plenty of other accountants who might not do this stuff, and that's fine, but we can't not. It's a huge amount of value that we give to our clients each year. Now, the process is we estimate your profit for the whole year. And the reason why I've got this little, hang on, over here, the reason why I've got this little circle here is we know what your September quarter looks like. We know what your December quarter looks like. It's in the past. March, it's just passed or we're finishing shortly if you've started this process early. And then we guess what June's going to look like. So that's kind of what we do from a profit perspective. Now, once we know that, we also kind of have an idea of what your tax bill might be. So let's say your profit's 300 grand, then these are all ballpark numbers. Your tax bill on that might be 100k, or roughly a third. Once we apply strategies, that's the process of working out what you can do from a legal tax saving perspective. It reduces your tax. Whoops, and then that's supposed to say 50 grand. Tax payable after the process is 50k. So that's a massive typo. The value, that's not what we want to happen. We don't want to turn 100 grand of tax into 250. I want to go the other way, but the value of tax planning. So that's kind of the thinking that I want to share, is that you'll, without any strategies, you'll have this amount of tax paying. Yeah. If you do these 2, 3, 4, 5, 6 strategies, you'll reduce your tax bill to this. So yeah. That's the kind of mindset.
And the key with this is proactive, right? Like once 30th of June rolls over, there's quite a lot of the strategies that you can't apply anymore. The ship has sailed. That's why we always say being proactive. And it's also a good session for us to catch up just generally and see what your plans are for the next 3 months as well, because there might be some stuff that you want to do could align with some tax strategies as well. And why not kill 2 birds with 1 stone?
Absolutely. Awesome. And nice little segue there is I've just sort of shared like you've got a plan before 30 June, and that doesn't mean you go and see your accountant on the 29th. Even that might be too late. And that's why we start our process literally like we started the messaging and getting our clients stuff together in very early March this year. So we want to get right ahead of it because sometimes there's money that needs to move around. For instance, there might be a little bit of money that might need to end up in super, and that maybe you can't pull 50 grand out of the air on the 29th of June, and you might miss the cutoff. So that's the sort of stuff we want to make sure we've got this planned in advance. So massive point there is start this as early as you can, and even now is like almost the latest you want to be starting this process. Cool. Now I do want to share those results of what tax bill are you expecting. That's the button there. So I think on your screen now you'll be able to sort of see, but the options were, what are your tax bill? Same amount as last year, less than last year, more than last year, or heaps more than last year. So, so if we combine the more or the heaps more option, that is well over 50% of the people who have joined the webinar now. That's pretty interesting. So more than half the businesses joining have done really well compared to last year.
Yeah, and kind of thinking of like a situation here. Look, paying tax is something that everyone has to do. It's something, what's that saying? Death and taxes. But what you don't want is to tip the government. But in a really good spirited way, I'm saying that is that you can manage your tax to keep it as low as possible, because if you don't, it can blow up. So there's this portion of tax that you pay, whether it's more than last year or heaps more than last year. Within that, there's a portion that you don't necessarily have to if you manage it properly. So what we aim for is to pay the right amount of tax on the profit that you have, not a dollar more, not a dollar less either. That means you're doing something dodgy.
Yeah.
So it's just the right amount for the right profit. And it's just about being proactive about it. And we're not here to say, start opening accounts in the Panama and not pay any tax. We're not here to do that. That's absolutely not what we're in for. Is to pay the right amount of tax that is suitable for your situation, essentially.
Absolutely. And then I know we've got a few clients who are on the call today and will be already a part of this, if not maybe even contributed to this. But we're also excited as a team to launch our Save 2.1 mil in 2021 campaign, which is a massive goal for our team to save $2.1 million of tax by 30 June 2021. And it's interesting that we've actually, and this was at the end of last week, we've already hit 260 grand out of that target. So just over 10%, which I'm blown away with. So we've still got more work to do, and it's not going to happen without a lot of effort. But actually, there we go. We've reached 261 grand already. But it's something that we're focused on absolutely as a whole team for the next 12 weeks. And if you do want to be a part of that, I will be sort of sharing this again towards the end, but we can have a strategy call with you. So feel free to book a strategy call with an accountant. Rose will post a link if you do want to do that in the chat box. And usually you can get a call the same day or the next business day with one of our accountants. So if you do want to explore what that might look like, and you not only saving tax, but also contributing to that massive goal. So we just had a, so thank you, Rose, for popping that in. Now, the 12 biggest tax saving strategies. And as I mentioned, we've got more than 12. So why not? We threw a couple of bonus ones in there. Whoops, sorry, I should have stopped sharing those results. There we go. So so we're going to run through the 12. Before we start those 12 though, I just want to share a bit of context in terms of tax rates, because these tax rates can be a bit confusing, and I don't want to be sharing numbers. There's not many numbers for the rest of the slide deck, but I do want to sort of share these key tax rates that we've got here. Now, as an individual, the tax rates have actually changed from 2021 financial year versus the year beforehand, and that's around this sort of tax bracket here. But with individuals, the more money that you earn, the more tax you pay as a percent. So you can see here, the first 20 grand, you pay no tax at all. that's what we call the tax-free threshold. It's a bit of a tongue twister. Now, 20K to 45, you're looking at 21% tax, and this includes the Medicare levy, by the way, the one that everyone pays. The private health insurance one is on top of this if you don't have private health cover. Now, this bracket got bigger, which is pretty cool.
Mm.
So it used to be 45 to 90. Now it's 45 to 120 grand, around the 34.5% mark. So that's about a third of your income going to the government in this bracket here. 120 to 180, you're paying close to 40% there, and then 180 or more, close to half your profit. So we definitely want to stay away from from this bracket here, if we can, from a tax planning perspective. And I'm not saying don't earn the money. If there's certain structures that you're in that you can't actually change this stuff, and you're stuck, but better to earn $1 and pay 47% tax than not earn the dollar in the first place. So, but if you can keep as much of that money as you've earned, then why not do that? So that's individuals. The company tax rate, it depends on your turnover. Now, most businesses in Australia will fall under this category here of under $50 million in annual turnover. If that's you, you're looking at a 26% tax rate. It's a flat tax rate. It doesn't go up the more the company earns. On the first dollar, you pay 26%. On the millionth, you pay 26%. Now, if your turnover is greater than 50 mil, or you're an investment company, like a bucket company that we use quite often at Inspire, you're sitting there at 30%.
Mm-hmm.
Now, last one here is trusts. So I've got 0% there. It's technically not correct because trusts give their profit to other people in the family group or other entities in the family group. So trusts themselves don't pay tax. They sort of share the love around, and then the person receiving the money pays that. So I do kind of want to get a bit of a gauge as well. I'm going to throw another poll up, which says, what is your business structure? So if you know what that is, I'm just company, trust, sole trader, not sure, or I don't have one. We'll see what that's looking like.
Yeah,
And
and you might have multiple structures, and I think the most important is your business structure. So if everyone's wondering, oh, I have companies, I have trusts, I have so many different things, what's the business structure that you run your business through? And that's what you want to vote on. And while everyone's doing that, I just want to add a little bit of an interesting kind of not twist, but a little bit of a bringing awareness to this a little bit. So with trust, it says 0%. Because it really depends on where that profit goes. Now, there is a bit of an asterisk on that. For that profit to go to someone, you need to do what we call trust distributions before 30th of June. Now, without getting too technical, if you don't do that, you might end up paying the top marginal tax rate, which is at 30%. So another part of proactive tax planning is not only to save you tax, but also to make sure you're not in trouble in terms of compliance, or you're not missing those things and ending up having to pay the most amount of tax just because you didn't do your trust distribution minutes for the year. So it's not here because we never miss on that. So we want to make sure that your trust always distributes that to the beneficiaries. Cool. We got some results.
Run us through those results, Riz.
Yeah. Oh, so most of them are in companies and trusts.
Yep.
Awesome. We've got a few sole traders. Not sure, don't have one. Okay, cool. So what it looks like is most of you are going to see, you have some sort of structure which tax planning will be a consideration. Now, if you're a sole trader, that's something that it just depends on your situation. Sometimes you have to be a sole trader, or you haven't had any advice on getting out of it, or it's not time to do that yet. But typically speaking, with a sole trader, technically you're an individual. That's your tax rate itself. So that what Ben's circling there. It's awesome to see everyone having some sort of structure there as well. And everything that we're going to be talking about today will be relevant for each one of you, not just companies and trusts. So it's good to have a bit of a gauge where we're heavy on in terms of the audience today.
Awesome, cool. Well, we might get into the strategies, hey Riz.
Yeah, let's do that.
And we might go one-on-one. How's that? All right, and how about you kick us off with salaries paid to business owners? What are the things to keep in mind, and the traps that you've seen?
Yeah, so something that we have to be clear on is whenever you're a business owner, you're essentially wearing two hats. One hat is as a business owner, one hat is maybe as an employee of the business, a director, or someone who's technically delivering to the business. Now, in the case that you do deliver for the business, I use a tradie as an example. You might own, a tradie, an entity that runs, building works and all that stuff, but he might also be a carpenter in that business. So in that situation, what you can do is actually pull out a salary as well. Now, the issue here is that if you're not careful in how you pull your salary out, you could end up paying way more tax than you need to. So remember that you have two hats. So you're a business owner, you're an employee at the same time. Now, if your business is making a loss for that year, for instance, and it's already in a loss, including your salary, what is essentially saying here is that you're taking money from your business, putting it in your name to create that loss and overpaying tax in your name, essentially. So that creates a dangerous situation where if you didn't pull that salary, that business might be just above profit or in a break-even situation. So where we see a lot of errors when considering salaries paid to business owners is overpaying salary, unnecessarily overpaying salary, and you pay tax on that while your business is in a loss, where you don't necessarily need to do that. So there's other ways where you can pull money out of the business to ensure you don't pay unnecessary tax. Whilst you can use those losses in the future as carry forward losses if you're a company or a trust, the issue we're seeing now is you're paying tax now for a future benefit that we don't need to do that. More money in your pocket now, especially when we go through something like COVID, is ideal, very, very ideal. Um, and other things that I've seen as well with salary paid to business owners is differing amounts. There is a commercial amount in which you need to stay within the guidelines. So if someone who's doing 1 or 2 days of bookkeeping within your family, you can't pay them 200 grand a year for doing that. There's definitely some commercial amounts that the ATO considers, but also what you can consider is looking at your families. If your families do work in the business, considering what tax bracket each one of them are in is very important as well, because you can change the amount that you pay one another to make sure that you're all in the same tax bracket. And I think we might
You're skipping ahead, aren't you?
yeah, we might go through that a little bit later, but that's related. And a lot of the strategies do work together, and then we'll show a little bit of that.
Yeah, wonderful. All right.
So we got
Now,
cool.
so you're odd numbers, I'm even numbers. So I'll go with strategy number 2. We'll go work your family trust. So like I shared earlier, where I mentioned the trusts don't pay tax, they give it to other family members or entities in the family group, and then they pay tax on that. The choice of who to give it to is so critical with a family trust. Now, if it's set up right, you can give that profit to yourself, your spouse, your parents, your kids, your grandparents, there's a lot of people in your family that you might be able to give the profit to there. But also we look at things like bucket companies or even super contributions, which isn't technically a trust distribution. It's under a different sort of set of rules there from a tax perspective. But the choice of who your family trust gives that profit to is absolutely critical. And that's actually one of the processes we go through in our tax planning, is saying, all right, we've got 200 grand here to sort of spread across the family group. How do we do that? And we can show you different scenarios of, hey, if we give it all to you, here's what the result is. If you go, your spouse and one of your parents, here's the tax paid, tax bill estimate on that one. So it's critical. And as Riz said earlier, we also have to make sure we document those decisions before 30 June. And that's the trust distribution minute. So that one is done. So Riz, let's go to the amazing power of bucket companies, please.
Yeah, see how this is I'm gonna start linking some of this stuff in a second, but explaining the concept of a bucket company in the first instance is exactly what we have there. The picture of a bucket with an arrow pointing down. Now, that arrow signifies income or profit for the year that goes into that company. Now, why we call it a bucket is because a company pays its own tax. So it receives profit year after year after year, and it's like a bucket. It starts filling up with basically profit, and then you pay 30% tax on that. Now, the use of a bucket company is essentially a way for us to have excess profit stored safely away from the business so that we don't pay too much tax. Now, how that works essentially is, if we take that trust example before, in the situation that you have a trust and you start distributing to all your family members, and then you reach to this point where if we can remember tax brackets, it goes up all the way to 47%. You get to a point where it makes more sense to to distribute that money to a bucket or a
Mm.
company versus distributing it to an individual because of the difference in tax rates. Now, that's how a bucket company works. So if you think of it as like a waterfall, as the money comes through, the profit comes through each year, it fills up each individual's taxable income to a certain limit. The leftover goes into this bucket. And this bucket is going to be there, as long as you're making profit year on year, it's going to grow and grow and grow. So the value of this bucket company is always going to grow. But the beauty of it is you're always going to pay 30% tax on that max, and you're going to cap your excess profits rather than going in each individual's names, because then you can go up to that 47% level. So there's ways that you can take money out of the bucket company in the future. It essentially acts as your kind of nest egg for your family. All the individuals have received their money, they can live on it, they can do whatever. Excess profit, we leave it in the bucket, gets taxed there, but we can use that money for investment purposes or something else to grow your wealth outside of the business. But the beauty of it is you're not paying 47% in your name to then, use that for investment. You're paying 30%, and then you have a bit more capital to invest into the future. So it's a really powerful strategy. And today's very introductory. I'm not going to go into too much what you can use the bucket company for. But the idea is if you think about, if you have a family trust or if you have excess profits that you're paying way too much tax, if you don't have a bucket company that's receiving this excess profit, you're definitely overpaying tax. So that's something to consider.
Cool. Awesome. Thank you. Number 4. So we've got bringing forward or prepaying expenses. So here's the interesting thing. As a small business can actually prepay up to 12 months of worth of expenses of certain things and claim them in the financial year that they pay those expenses. Something we kind of see with this sort of stuff is you can prepay rent, whether it's 12 months or even just a few months. The timing of when you pay is critical in terms of when we are able to deduct that. But often we see things like, obviously COVID's a bit of an interesting one here, but if you travel regularly for work, whether it's hotels, flights, all that sort of stuff, then you can actually go and prepay your travel and book that in and actually claim that this financial year versus the next. And that might be actually, if you have a think about what you might want to do there, it might actually add up to quite a few $1,000s in tax savings. Let's say it's $20,000 worth of prepayments you want to make. That might drop $6,000 depending on your tax rate, but it might drop about $6,000 off your tax bill. So it can start to add up there. Awesome. All right, Riz, back over to you. Don't pay tax on money you haven't received.
Yeah, cool. And this one is just essentially you want to make sure that you only pay tax on cash that you have received. So again, using the builder analogy before, if let's say at 30th of June you owe some money, if someone owes you money, now when you run your P&L and your balance sheet, your reports, usually it includes any unpaid invoice in that profit amount as well. Now, if you essentially run your tax return on what we call accruals basis, that income that you've recognized before 30th of June, although you haven't been paid for it, which might be paid in 1st July, actually falls into your profit. You might get taxed on that. So what we do here Inspire is adjust that at the end of the year. Now, this is not necessarily something that you need to do. This is an Inspire accountant, and your accountant needs to take this into account, is to adjust your tax return to ensure that you only get taxed on a cash basis. So we exclude the amount that hasn't been paid at 30th of June so that you only pay tax on money you have received. Now, if you have a big accounts receivable balance, your business usually has that. That's something we need to consider. There are some criteria as whether or not you can apply this strategy, but that's something that you can work through your accountant whether it applies to you or not. But it's hefty. It is a hefty tax saving. What that means is you don't pay tax now. You only pay tax on that income next financial year, which really means it's 2 years later that you have to pay on it. So it delays it a little bit, but imagine what you can do with that money in the meantime, especially looking at the year that we've had recently.
Wonderful, awesome, and just having a quick look at the chat box. Adrian has asked, "Do you invoice your company with the bucket company?" So that's scrolling back a couple of slides. That was about the trust distributions to bucket companies. The answer is no. It's not an invoice. It's a trust distribution. So there's different paperwork rather than an invoice. Um, cool. Now, the next one here, number 6, is accelerated asset depreciation. So what this one is all about is when you buy sort of physical like stuff that's, let's say you run an office and it's desks, it's computers, maybe a car. Now we can't just go and deduct them off your tax bill like we could the running costs. Like let's say you pay rent, rent we can claim when you pay it. Even though you might buy a car, there's rules around not just claiming it all up front. So that's what we call depreciation, is writing that purchase off over a couple of years. Now with COVID, the rules around this has changed, and it's almost like every couple of years we get these rules changed. But the rule now is basically there's no limit of how much the purchase price of whatever you're buying is. You can write the whole thing off in the year that you purchase it. Now, keep in mind, construction is excluded. So we're talking about things you can go and pick up and move. So washing machines, you could, unplug and walk away with, but a wall or an extension to your office is construction. It's under a different division of the good old tax act, so not that one. And there's also a limit on certain cars. So most cars have what's called the depreciation limit. It's about 57 grand, and so depending on like utes and sort of commercial sort of vehicles are excluded from that. But yeah, so there's, what I'm saying is there's certain limits, but for, let's say, a laptop or a computer or a piece of machinery, if you're a manufacturer or something like that, can usually be claimed in one big hit, and there's no limit at the moment. So before you buy something though, check with your accountant to make sure you're all good to go. I just want to say that I'm not giving every single detail of the rules here, but yeah, this is actually a pretty cool thing this financial year where we've got no limit.
Yeah.
Alrighty, number 7 is pay employees super early.
Kind of links to that, prepay your expenses. Now, if you have employees, you know that you have to pay super every quarter. Now, at the last quarter of the year, which is the June quarter, usually that's payable on the 28th of July. Now, that's something you have to pay anyways. What I recommend is bringing that forward and paying it before the 30th of June. It just gives you that earlier deduction to reduce that tax for that financial year. It's just something that you want to consider doing if you do have the cash flow. It's something that you have to pay, and the money has to go into the bank account of the super fund before 30th of June. It's not when you pay it, it's when it lands in the bank account. So that's why you have to do this quite early. So I wouldn't even leave it to the mid-June because it takes some time to process some of this stuff. That's pretty straightforward. That also includes your own super. Remember how I said as a business owner, you could be an employee as well. Your own super you can consider to prepay early. Again, it's something that you need to do anyways. Might as well do it early if you have the cash flow. That's just going to save you some tax for that financial year.
Awesome. Awesome. Number 8, write off your small business general pool. Now, these are weird accountancy words, but if I go back to the accelerated depreciation, so this has to do with depreciation. Now, let's say we own assets from last year or the year before, which we were claiming over a number of years. What writing off that pool does, what we do is we actually pool all those assets together, or the written down value of those. And this year, there's also no limit on what we can write off with your small business pool. So a bit of a practical example, let's say you've got $100,000 truck, and you bought it quite a few years ago, where let's say the rules were 30% a year you could claim. So it went down to 70 grand was its written down value. Then I don't have a calculator in my head, unfortunately, but but it might go down to 50 and then 40 and then 35 and 30 grand. What writing off the pool does is mean whatever's left there, that 30 grand or the 25 or whatever it is, we can now claim in one hit. So yeah, it's basically a little rule there that's saying that we can claim whatever's left in your depreciation pool.
Cool.
Number 9, motor vehicle logbook.
Yeah, this is a simple one that can save you quite a lot of money. So this also applies to individuals as well. So if you're a salary earner, this is relevant as well to you. We always recommend our clients to keep a logbook of 12 consecutive weeks of the use of their vehicle, whether for work or for business. The reason for that is it is more likely that you can claim, it depends on the percentage, of course, but it is more likely that the deduction via the logbook method is a lot higher than the other method. The other method is a cents per kilometer method, where you calculate a certain amount of, I think 66 cents now per kilometer, maybe 60. But essentially, it just calculates a flat rate based on the kilometer. And there's a limit, there's a 5,000 kilometer limit as well. So you can't claim more than that. With the logbook, you can claim a percentage. So once you keep the logbook, you have a business percentage, a work percentage that comes up. That percentage is then applied to all your expenses related to that car: insurance, rego, fuel, repairs and maintenance, uh,
Depreciation. Yeah.
depreciation. That's a good point. Depreciation is cool. It's a bit different with individuals and businesses.
Mm.
Individuals, it doesn't have that accelerated depreciation rule, unfortunately, because you're not a business. The accelerated depreciation rule, where you write off the whole car straight away, is applicable only to businesses. Just jumping back to the previous strategy, but keeping a logbook is an easy thing. There's apps out there that you can use to keep a logbook. You'll find that if you're using a cents per kilometer method, I would suggest starting a logbook just to
Mm.
pick it up. Now, the other thing as well is updating your logbook. Now, once you have it, it's valid for 5 years, unless something significant changes in your travel pattern. Now, I recommend updating it if you suddenly find that you're using your car more often for your business. Straight away update that, you get a bigger deduction just by way of, just tracking a little bit more trips that you're doing.
Awesome. Alrighty. Number 10, be sure all family members are in the same tax bracket. So Riz gave this one away earlier. So what we want to make sure is where we can choose to pay trust distributions or salaries, and basically choose different family members and put money in their name, let's say. We want to make sure they're all in the same tax bracket. So what we don't want to see is, let's say you've got 200 grand in a trust to distribute. If we put it all in one person's name, they're going to be straight to that top marginal rate of 47% tax. So it's not great. But if, let's say, we split 100 and 100, that we've got two spouses, 100 each, then we drop down to that next one down. Actually, sorry, two brackets down, which is 34.5%. So it's a lot less tax when you look at that. From a bracket perspective, so we don't want to have like unequal brackets. We want to bring them as close as we can, and that's not the only rule with trust distributions. If we've got enough cash, we want to consider things like bucket companies, or other family members like parents or retired parents, all that sort of stuff. So and sometimes we don't want them in such a high tax bracket. So it's not the set and forget, that's all you do. It's just one of the things we consider with tax planning. Number 11, repairs and maintenance.
This is again similar to prepaying expenses. It's just making sure that you do a bit of a check on, and I don't apply to this across quite a few things. It's just making sure you do a quick check of what you need to do to your cars, to your business premise, or even if you have rental property, you can look at that as well. Repairs and maintenance is something that you're generally going to do. The reason why we identify repairs and maintenance is we don't ever, if you've heard that office work strategy, go out, buy a laptop, and then save 30 cents on it. We never recommend saving 30 cents, by spending it all. Now, where repairs and maintenance is something that you probably need to do anyways. Now, there's a return on investment on this. What we recommend is doing that before 30th of June and looking through what repairs and maintenance are available, or something that you've been putting off a while. Bring it forward, do it before 30th of June, and make sure you kind of assess even all across your business, your cars, and even your rental properties as well.
Yeah, good point. Actually, you mentioned it there, the rental properties. Like if something needs replacing and you got to do it in the next, let's say this year sometime, then why not do it a little bit earlier, this side of 30 June? And again, the reminder there is it doesn't include construction. So, so you can't just, go and add an extension and call it repairs. The other thing as well, there's a little rule with repairs to say that if, let's say, you've got a I can't remember the name of it, like a wooden bench top that's pretty dated, you can't go and take that out and replace it with marble. That's almost like an upgrade rather than a repair. So again, if in doubt, chat to your accountant and get their take on it.
Mm.
Number 12 is for me, actually, I think. Write off your bad debts. So if you're owed money that you think you're never going to see the light of day, and that could be just it happens from time to time in business, or it could be COVID related, then it's good to sort of consider each of those debts that are owing to you that don't look too likely to come through. And if you write them off and make a note that, hey, we've tried to get this amount, it's probably not going to come through, we're going to write off the bad debt in our books, then you're allowed to get a tax deduction for that, but do it by 30 June as well. I think the deduction is when you decide to write those off. Now, let's say it did come through a few months later after 30 June. You would have to pay tax on that amount, though. You just need to re-invoice or bring that invoice back to life. But the key is writing off anything you think is not going to be paid.
Yeah, and I've seen so many people who have bad debts or accounts receivable balances that hasn't been reviewed for a while. It's just as simple as just running your eyes through it and see this guy. I haven't heard from him in 6 months. Unlikely. Mark him as a bad debt that you want to write off. So reviewing that, it's a very simple activity. You should know exactly who's likely to pay or not, and you just don't pay tax on someone that's not going to pay you anyways.
Yeah, yep, that's it. Hang on, we've had that before.
Had that before.
We're tricking everyone. That's the bonus one. We've already talked about it. Investment property depreciation. This one's a simple fix if you do own an investment property. Now, with depreciation, I've spoken about in the context of a business, but with a rental property, we can actually claim the furniture and fittings and the curtains, the flooring, that sort of stuff under depreciation rules. And the other thing as well with rental properties is we can claim a portion of the construction cost. So let's say you've got a house and land package. The land package was 200 grand and you paid 300 grand to build a house on it. We can claim a portion of that $300,000 construction cost. And that doesn't mean you need to build it to claim that. All you need, even if you're buying a second-hand property, you didn't buy it new, we can still claim that construction element of it. So the thing to do here is make sure you get a depreciation report for every rental property that you own, and there's one business that does it that we refer to that say if it doesn't pay for if the depreciation tax benefit doesn't outweigh your cost of your report, we'll give the money back. So it's pretty cool, and it usually saves a couple of, depending on the construction or what you're allowed to claim, it's usually a couple of grand a year that we see in tax benefits just from that.
Yeah. And even if it's something that you're not sure of, just ask yourself, do I have a investment property? Yes. Do I have a depreciation report? No. That's something you need to start talking about straight away. You're missing out deductions or you're missing out an opportunity there straight away.
Wonderful. Well, that brings to the end our 12 plus 1 tax saving strategies. If there's anything you want to sort of us to clarify, just again pop it in the Q&A box. It's been pretty quiet there. But we'll keep going through the other things we wanted to share. The next one is the tax impact of COVID stimulus measures. So I guess there's two main ones that we saw last year be announced, which was the cash flow boost. And that's if you employ someone, including yourself. It didn't really matter as long as the business employed someone, then you're allowed what they called a cash flow boost. Now that was anywhere between, I think, $20,000 up to $100,000, depending on how much pay-as-you-go tax that you withheld from your team members. Now the great thing about this one is there's no income tax on that amount. It's not assessable income, which is amazing. So if you're one of the people who received $100 grand boost and thinks that they need to put 30 grand aside for tax, you don't need to. So wonderful. Now the second one here is JobKeeper. So There is tax on JobKeeper. So the thought process there is you had an expense of wages, you had income to supplement that, and so you net the two across. You net the two off. So there is tax to consider. So it does actually count towards your other income for the JobKeeper amount.
Yeah, and practically with JobKeeper, essentially, it's a supplement to your wage bill. Now, if you receive $100, you pay $100, you pay no tax. It's in and out. But if you receive $100 and then you pay $100, but then because of that you receive more income on top of that, that's what is tax on it. So it's a bit confusing when you say JobKeeper is tax, but really it's the outcome of supplementing your wages creates more profit because you have less expenses for the year, essentially.
Yeah, absolutely. Very good. Alrighty. Well, we will do Q&A in a moment. I just wanted to share a few things we've got coming up, if that's okay. So that kind of brings to the end our tax saving strategies. We mentioned COVID, but we've got a couple of things to share in the last few minutes before Q&A. And thanks for sending those questions so I can start to see a few. The first one is we've got a webinar coming up on Friday the 23rd, which is actually a fortnight away. Now, I've got an asset finance specialist, Ashley Smith, and we're going to actually go through what's happening in the market from upgrading the car, work utes, or equipment. Basically, he goes and finances assets, whether it's vehicles or equipment, bobcats, trucks, all that sort of stuff. So, I had a conversation with him a couple of weeks ago, and he's saying that things are taking so much longer to come in and get delivered. Even cars are taking 3 months or so. So, yeah, we're going to deconstruct what's going on, how to approach financing there, and also an encouragement, if you do want to do this stuff, do it now, because we can't actually claim a piece of equipment until it's delivered to you as accountant. So it's got to be installed and ready for use. Again, we're going to go through a bit of detail there. Another reminder on our Save 2.1 mil in 2021. So we're going to be doing a weekly update on how much tax we've saved in the last week, but also how our total's doing. Plus, we've got daily tax saving strategies. I've also seen a few questions pop in about, what about individuals? You're focused on business here. Yes, that's our primary focus on this webinar, but we do have tax saving strategies for high income employees, and we're going to be sharing a few in those daily videos there. So if you're not already doing it, follow us on Facebook, or even me personally, you can follow me, and we'll be sharing those videos out every day, which is pretty cool. Another reminder is if you are interested in talking further with one of our accounting team, please book a strategy call. There's no cost to it. There's no obligation to even use us. Book one in, have a chat to us, see if we can help, and you're fit for this, and even ask questions about what the tax planning process looks like. That is totally fine. And again, we can usually get same day or next day bookings with our accounting team. Very cool. So that rounds out the webinar, or what we had to chat through today. I can see a handful of questions there. Please keep adding them. Riz and I have got the next, what are we looking at? We've got the next at least 10 minutes to go through this stuff with you. So how about we do one and one again, Riz? Do you want to kick us off?
Maybe. But before we do, Ben, I think that there was one thing that I just wanted to add to the changes from last year. So if anyone said that they're paying less tax than last year in that poll, and maybe because you're not paying any tax or you're in losses, something that we didn't get to cover today was actually some changes from last year's budget. There's a new strategy that we're putting into play before 30th of June called the loss carryback provision. So the criteria, I'm going to slow down here. The criteria is if you're running a company and you're a small business, if you made a loss in 2021 financial year after this 30th of June, you can apply those losses against prior year profits that you have made to get a tax credit back. Repeat, if you're a company, you made a loss this year, you can apply that to your prior year profits to get a tax credit back. Now, it doesn't mean you amend your returns or anything like that. It's just that we use those losses backwards. It's quite magical because you're basically recouping prior year tax money that you paid. Now, that's a massive incentive by the government to essentially help out businesses that, who's going through COVID and got it really hard. And not only they don't pay tax this year, they get a little bit of the tax back from the last few years as well. Company losses, prior year profit, and you get tax back. That's it. Okay.
Awesome. Very good. All right. Well, I'll run through the first question. And Ronnie Barber, okay, Ronnie, you've asked, hi guys, how does depreciation work on equipment that is leased? So it depends on what you mean by lease, because there's this kind of, when we talk about leasing, there's finance leasing where you basically loan money and it's called the lease, which I think is confusing. Then there's an operating lease, which is basically like paying rent for something. You don't own it, but you're paying rent, and it's usually a sort of fixed term. So the difference is under the finance lease, which sometimes we call hire purchase, then that's where you own the asset, and we can claim depreciation on it under the depreciation rules. If you're under an operating lease, or then and you're renting the equipment, then you cannot claim depreciation. Instead, you claim those rental payments. So that's kind of how that one works there.
Cool.
All righty. Riz, you want to go the next one?
Yeah, I might go. I'm just trying to pick one here. I'll go with Guy first. Any advice on car allowances from an individual/company owner perspective? Well, when it comes to car allowances, usually what typically happens when there's a company that you work for, if you use your car for work purposes, instead of the business supplying a car for you, you use your own car. The business then pays an allowance to you to reimburse for any costs for using your car. Now, that reimbursement is usually included as your income, included as taxable income. And usually what you do is you then claim the deduction on your car, so it offsets each other. So if you use all your allowance for your car expenses, there should be no tax payable. Now, if you own your own business, typically speaking, we would first of all go a step backward and ensure that any cars that you buy is bought in the business in the first place. So that you don't have to pay the allowance, and essentially you use the car for business purposes, let's say 80% business purposes and then 20% private use. Then we just take up that private use as a contribution that you make to the business, essentially to recoup that. So it's the other way around. You're reimbursing the cost of the 20% to the business for using that car. You don't necessarily need to take an allowance out for that unless you own that separately. So this is probably where Guy's coming from. If you have your personal car and the business is you're using that car, you can pay yourself an allowance. That's right. And I would pay the exact amount to the amount of expenses that you've used for the business. So you want to do a summary of what your expenses are, reimburse that from the business, so that you essentially the deduction is in the business, not in your personal name. Now that's generally how it works. But again, the level up before of having the car in the business has other benefits as well. One of the big ones is depreciation we talked about before. Owning the car in the business means that you can claim the depreciation upfront. So maybe join Ashley on that webinar on the 23rd if you need to upgrade or change your car and buy one in the business. It'd be an interesting topic to look through for you.
Awesome.
Thanks, Guy.
Alrighty. So I've got one from Leandri Berger. We have been considering to replace our ceiling in the clinic. It is outdated, but mainly that we became aware that it is not soundproof. For patient privacy, we obviously need to improve on this. Guessing it would be seen as construction. So I guess this is a perfect example of that. This appears to be a upgrade to the roof versus, let's say you had a leak in the roof and it was raining and the ceiling was getting moldy or whatever, and then you replaced it like for like. That's repairs. But yeah, I'm sort of seeing this more as a bit of an improvement, unfortunately, Andrew.
And it doesn't mean you don't claim the depreciation, it's just slower over time. But it is what it is. If you have to improve it, you have to improve it. And there's no two things about it. Jen, I'll answer the first one. Bucket company, meal allowance. I have a sneaky suspicion Jen might be an accountant here. This is good questions. Bucket company. Must the distribution money need to be paid to the bucket company? If yes, when? Yes. So just for everyone's benefit, the bucket company, taking it back to context that everyone can understand that, bucket company will receive a distribution, let's say this year, and you say, look, you're going to receive $30,000 in distribution. Now, at 30th of June, you sign a trust distribution minute. And what happens is it becomes a trust distribution receivable in the company. Now, you need to pay that cash into the company because legally it is the company's money. Once you do that trust distribution minute, wherever it goes, it's legally that person or that entity's money. If you don't pay the money, it essentially means that you owe the money to the bucket company, or in essence, you borrowed that money in a way by not paying it back. So there is what we call a Division 7A, getting a bit technical here, Division 7A loan that we need to consider. Now, if you don't pay before the next financial year ends, it becomes a Division 7A loan, which means that you need to make minimum repayments on that loan and also charge commercial interest for that. So uh, you typically what happens is we distribute the money, and then if the money is used somewhere else, because that's profit in the business, the cash is somewhere. If the money is somewhere else, we suggest that the business owner transfers the money to the bucket, and then you can still borrow that money if you need to invest it somewhere else. It just means that we need to draw up a loan agreement between the company and wherever that money is gone. But yeah, great question. And I might do a double here then because it's just
Go
one.
for it. Yep.
And Jen, you had a question about meal allowance on PAYG summary. Can you claim the whole amount as a deduction as well? Great question. So one of the things that, again, bring it back to context for everyone, something that you can do as a business, or well, as a business, is to pay a meal allowance for your employees. Now, the reason why you pay a meal allowance is, let's say if they, went for a business trip and you send them off for a seminar and you pay them a meal allowance. Now, that meal allowance is usually included on your PAYG summary if it's above a certain amount. So the ATO releases a ruling or guidance showing what a reasonable amount of allowance is. If it's below the reasonable amount, you don't have to include it in your PAYG summary. It's not considered income, but it's still a tax deduction to the company. Now, if you're a business owner, the big benefit of doing that is essentially if you, as an employee of the business, it is, and you work overtime hours. Sorry, that's another thing that I forgot to mention. You have to work outside of normal hours. It has to be overtime meal allowance. And if you work overtime, which most business owners do, I don't know when's the last time you worked 38 hours a week, Ben, but most business owners do that. So what they can do is they can pay the overtime meal allowance in their name, not get taxed in their individual name, but essentially get that deduction in the business as a meal allowance. So your question here, Jen, can you claim the whole amount as a deduction as well? It depends what level are you entering it at. Now, if it's above the reasonable amount, you just need to claim the expenses against that allowance. Obviously, those expenses have to happen in the first place for you to claim that. If it's below the reasonable amount, you don't even need to include it in your PAYG summary. It's not taxable.
Awesome. Awesome. Well, thank you for that, Riz. That was extremely detailed. That's great. Awesome. All right. Well, that is all the questions we can see at the moment, and we are 1 minute from our finish time. So I think that might actually be a first for you and I, Riz. But as a reminder, there's some links in the chat box if you do want to. Rose has posted stuff about the webinar we've got coming up, social media to follow for those sort of 60-second videos for our tax strategies over the next 3 months, and also a strategy call if you do want to talk further with our accountants. So that's it for today. Good to see so many people in here, some familiar faces, which is good. And we will be seeing you in a couple of weeks for the Asset Finance webinar. Thanks, Shalita. Thanks, Michael.
Thanks, everyone.
Appreciate you joining. Wonderful. All right. See you very soon.
Thanks, guys.
Thanks, Leandri.
Thanks, Kim. Thanks, Kylie. Thanks, Jen.
Wonderful. All righty. Thanks, Michael.